In this module, we are going to discuss the Focus on Practice Inspection document issued by CPA Manitoba in November of 2024. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. And this kind of, unfortunately, is a list of things where we have not been efficient and effective, where we have not followed professional standards, and where we have not documented things properly. Now, what does this mean? Some procedures are suggested. Is the practice inspector telling us that all of these are required procedures to be done in all audits? And no, of course not. Audits are risk-based. Procedures are proportional to risk. What the practice inspector, I think, is trying to do is illustrate to us the kind of procedures that might be done. So the specific procedure recommended is illustrative. They say may do this procedure, so that means you may do some other procedures. And so some of the suggested procedures might be done, but it depends on risk of material misstatement, how extensive your procedures are. Now, deficiencies are sometimes noted with reference to a standard. Is this the correct standard? Well, of course not. The practice inspector is abbreviating, giving a précis of the required standard, and sending you to a place where you might read the standard. Now, what should be happening is you should know the standards, and you should already be aware of them, so when the practice inspector says you should be doing this, you should go, oh yeah, that's in this standard. Practitioners should consider these deficiencies and consider if they apply in their assignments. Do the deficiencies noted exactly relate to the standard noted? Are they exactly quoted from the standards? Well, no, of course not. As I said just before, these are a précis. They're sending you to specific spots in standards. You're supposed to know the standards. And many standards are interrelated. They refer to 315.17. Well, as we'll discuss later, 315.17 and 315.18 are not things that have to be documented. Doesn't say in those standards, but by the time you read 315.38, you go, oh yeah, what's in 315.17 and 315.18 is required to be documented in accordance with 315.38. So read the standard. Why do standards require that I do so many silly procedures, so much silly work? Well, they don't. My view, most standards, almost all of them, describe something that a practitioner would want to do even if it wasn't in standards. They're pretty much common sense. Now, some standards, 240.33, and we'll talk about that later, are a bit political. There was a big fraud that occurred, and there were huge journal entries made at year-end, which the auditor somehow or other didn't pay any attention to. Now, in a typical audit, complying with 240.33 isn't going to take a lot of time. Do it anyway, because fraud is a big risk. The odds are like 99% you're going to miss it. So if there are procedures and standards that you should have done to try to catch the fraud, and you haven't done them, you're placing yourself at risk. Now, to some extent, I say, come on. These are deficiencies that are Canada-wide and international, and many of these are repeated from previous reports, so come on. Let's get on this. Now, I'm also going to, last year I did this, something on this last year. I didn't go through the accounting issues, but these are things where you have to do something in an audit or a review. So I'm going to talk about all of these issues. Now, I think the other perspective we need to have here is the practice inspectors have been repeating this for years and years. How does the practice inspector get the attention of practitioners. What do you do or say to get the attention? Now, in some situations, I think they've gone a little overboard, but I suspect what's going on here is they've said, this is required, and you're not doing it. And so they're trying different ways to get practitioners' attention. Now, the other thing is it sounds like the practice inspectors are being a little whiny about, oh, document this and do that, and this shouldn't be this. These are all items that put practitioners at risk of being sued. If you disclose interest debt that's due on demand as long-term, and it's really due on demand, the financial statements are potentially really wrong, and a user is going to rely on them and be really mad when they find out that the statements are wrong. So these are things that have to be addressed. They are not just picky little disclosure things, oh, I didn't do this. These are things that really put practitioners at risk. And I suspect there are other things that the practice inspectors have found that they haven't mentioned in this report. You need to be following professional standards, documenting it properly. Very important. So accounting issues, let's talk about them and how you need to respond to them in an audit or a review. Debt due on demand is current. It's always been current. It's never not been current. So you need to be careful about that. Related party transaction loans may be current or may not be current. That's one where if you're doing an audit or a review and you look at a related party receivable payable, there may not be terms and conditions expressed. And that may be something where you need to go to the client and say, could you please prepare documentation that describes what the terms and conditions of this related party loan are so it can be properly disclosed. The other thing they point out is just because you're making monthly payments doesn't necessarily mean it's long-term debt. It could be a demand loan where you've agreed to pay $1,000 a month, principal and interest. But it could be a demand loan. So in an audit, you need to check this somehow or other. I would highly suggest a representation letter paragraph. That's my recommendation, not theirs. In a review, all you do is inquire. Analytical procedures don't help. And again, I would highly suggest a standard representation letter saying the bank debt we have is long-term, whatever is required or necessary. Now, here's where the practice inspector is trying to get our attention, and they may have gone a bit overboard because this is something that's been mentioned for years and years. When performing review or audit engagements, practitioners must perform and document procedures to support the classification of callable debt. I'm quite sure I agree with that. This may include reviewing loan agreements and the creditor's waiver of its right to demand repayment. Now, anytime you say may, it means the same thing as may not. So there's something that might be done, but it doesn't have to be done. And I think sometimes people read these reports and go, oh, I have to, in all audits, review loan agreements, and so I'm going to make that a standard procedure in all audits. Well, audits are not procedural, so making that a standard procedure because you think the practice inspector said you had to is incorrect. Now, we have to interpret this with care. In a review, the only procedure is inquiry. So reviewing loan agreements in a review engagement is not required. Now, you might have to if you look at it and go, you haven't done this right. Then you have to go beyond inquiry. But the standard procedure in a review engagement is inquire. So must perform and document, I think, is a little inaccurate in reviews. In an audit, we are supposed to have done risk assessment procedures. And the risk assessment procedure probably should have included a review of the loan agreement. And that may deal with this. That may be all you have to do is in your risk assessment procedures. This is a pretty high-level procedure. Taking a look at the loan agreement and making sure that it's properly classified. And you may have to only do it once when the loan is originally granted, as long as you ask the client any changes to the loan terms and they say no. Put it in the representation letter. Now, showing debt due on demand as current may be enough. You don't, if it's due on demand and you show it as current, you really don't have to do much more. You have adequately described it as a short-term demand loan, due on demand. So this doesn't necessarily have to be a lot of work or a lot of effort, and we certainly do not need standard procedures in an audit. Audits are risk-based. Procedures respond to the identified level of risk during planning. In a review engagement may include, it may be enough, inquiry may be enough. The only thing I would say is I would be inclined to put the results of my inquiry in a rep letter. I don't like, and I'm going to say this again a couple of times, I don't like documenting inquiry of management in the file. I like inquiry of management to be documented in writing, signed by management. That's why I like it in the rep letter. Because if you inquire and say, I asked Bill, and Bill said it's long-term, and later Bill will say, I never said that. I always knew it was current. I like to get that in writing, signed by A, management, and B, someone on the board of directors, those charged with governance. Now, if demand debt is shown as long-term debt, that's a real problem for a practitioner, so you have to pay attention. Now, the procedural suggestions made by the practice inspector could work. They are suggestions. They might work. What you as a practitioner have to do is something that does work, and it doesn't have to be that complicated. A receivable with no repayment terms. Now, a receivable with no repayment terms is probably long-term. If it's a related party transaction, I don't know whether it's long-term or short-term, and that's again something the client needs to document more carefully. A receivable with no repayment terms. Yes, we owe you the money, but no, we may never pay you. I think it's probably more likely that it needs to be written off. Yes, we agree we owe you money, but we're never paying you. Well, that needs to be written off. Now, again, they suggest a procedural approach, which I've said it's kind of wrong. You need to assess risk of material misstatement, and then you need to do whatever procedures are necessary, which might be, even in an audit, only inquiry. Other assets that may not be current. A prepaid expense that lapse over year-end. Prepaid expenses are not necessarily current. They could be long-term prepaid expenses. And remember, a lot of things that used to be eligible prepaid expenses are no longer. A prepaid expense has to be effectively something that will be repaid in cash effectively, or could be. A 12-month term deposit signed 1 month before year-end. That's long-term, not short-term. Now, again, they suggest procedures. Again, what we really should do is assess risk of material misstatement in planning, get an understanding, look at each of these things and decide whether they're really current or long-term, and then do the needed procedures. And again, the needed procedure might just be saying to the client, oh, that has to be classified as a long-term term deposit, not a short-term term deposit. Term deposits are not necessarily short-term. Related party transactions. Missing or incomplete disclosure is common. Come on. This has been required since 2011. So we need to pay attention to this. The other thing about it is you really kind of only need to do this once. The disclosure, the measurement and disclosure issues are kind of complicated. But once you've got the disclosure down, you don't need to change it next year. So if you get it right once, and that will take some time, but you don't need to do much the next year because it continues to be the same. Now, it's a complex accounting area, so we need to pay attention to this. In an audit, it's a procedural approach. Section 550 specifies a list of procedures. You got to do them. You got to do them all. Have an audit program that corresponds to Section 550 and do it. In reviews, all we do is inquiry, 2447, and there's a requirement to be alert. Have a checklist step. I was alert for stuff. And again, this needs to be in the rep letter. The results of our inquiry need to be in the rep letter. And this can be pretty simple because the management can say the related party transactions are as disclosed in the financial statements. The related parties are the ones we've disclosed in the note, and the terms and conditions are as disclosed in the note. So that can be pretty simple disclosure, but I want it in the rep letter so that management has agreed in writing. Their inquiry is documented in writing. Must identify all related party transactions. That word is wrong, must identify. Be more correct to say in an audit, obtain reasonable assurance that all related party transactions have been identified, because we can't get them all. We're going to potentially miss some. That's by definition in an audit, there's a risk that you miss something. In a review, nothing has come to my attention that I did not identify all related party transactions. So the word must is wrong. I think the practice inspector is trying to get our attention because this is something that's gone on year after year after year, and it's a significant risk to practitioners. If you miss this, if you have not done the required procedures in an audit, if you have not done the required inquiry in a review, if you have not understood the transactions, both in an audit and a review, you're in trouble. And just to be picky, in the audit report, reasonable assurance is a high level of assurance, but not a guarantee that there are no material misstatements. So right in the audit report, we say could be material misstatements. It's kind of unclearly written, but in an audit report, having done an audit, we could have missed something material. And we say the same thing in slightly different words in a review engagement report. So the word must is wrong, but that we should be doing something as opposed to nothing. We clearly need to be doing what is required. Redeemable preferred shares may be a liability, probably are a liability. They changed the accounting rules around this. They used to be always equity. Unless there are very specific circumstances, they're probably a liability. Be careful, check, document. Again, this is something you only need to do once. And you're probably involved somehow or other when these redeemable preferred shares are issued, so you'll be able to determine upon issuance whether they're a liability or equity, and have documentation and make sure it's presented correctly in the financial statements. Revenue recognition on long-term contracts. Complex accounting area. If you have a client with long-term contracts, you need to pay some attention to this. You need to assess risk of material misstatement. You need to obtain an understanding. You need to do risk assessment procedures. Then you need to do appropriate audit procedures. In reviews, you inquire. NPO restricted contributions. They have observed that they see these being done wrong. They are accounted for not based on the restriction. Don't do that. Check that it's being done right and don't do it. Disclosures, financial instruments, 38, 56, 53, secured liabilities, 44, financial instruments, 38, inventories, 30, 31, 35. You have to disclose, for instance, the cost formula and cost of goods sold. So you have to disclose not just cost of goods sold, but cost of inventory sold. And use of the deferred taxes payable method. There's the reference. If you're going to use the deferred taxes payable method, you actually have to do more work and more math than if you used the the deferral method. It's the same math. You got to write a long note in which you describe everything you would do and take care of by recording deferred income taxes. The other thing in a small audit is pretty simple to decide that tax depreciation, capital cost allowance, and accounting depreciation can be the same. And once you make them the same and have fixed asset, net fixed assets and net undepreciated assets the same, then you don't have any deferred taxes, and that can make things really simple. So if you wish to make life complicated for yourself and have depreciation different from capital cost allowance, go ahead. Then you'll have either deferred taxes or a lot of work to do on 34, 65, 88. Do it. Now again, most of these all of them have been in place since 2011. That's 13 years. So for 13 years, we haven't got the financial instrument disclosure right. For 13 years, we haven't got the inventory disclosure right. And for 13 years, we haven't got the tax disclosure right. Come on. On those 3 items, and there's actually 3 things for financial instruments, check and make sure that the disclosure is right. And once you've got it right, and once you're in the process of doing it the proper way and have the right note written, not much needs to be done each year. So you're going to have to spend some time making sure that it's right. But after that, and get this right now, don't wait for the practice inspector to come and say, you've done this wrong, you've done that wrong, this disclosure is missing, that disclosure is missing. Get it right in all your files right now. Now, they suggest a procedural approach, and again, I think this is because they're a little bit annoyed that people have not paid attention for years and years and years. I think some people are misinterpreting this and saying when they see the practice inspector report say, here's a procedure that you may do, people decide that I'm going to do this in every audit. And you'll find your staff, perhaps, reading this report and going, oh, I'm going to do this procedure now in every audit. And you'll start to wonder why it is that audits are way over budget. In audits, you plan and understand and assess risk of material misstatement, and then you design procedures in proportion. In a review, in these particular areas, the only required procedure is inquiry. And you also have to do analytical procedures, but they won't help. Again, I suggest in review engagements, all of these things, all of the results of these inquiries with management be documented in the representation letter. Now, how I interpret this is these are not, you should not interpret this that these are procedures to be done in all audits. Audits are risk-based and not procedural. Rather, you should be interpreting this as the practice inspector in shorthand is saying, please do something. Debt due on demand, come on. Pay attention to it, make sure it's disclosed as current, and do the procedures suggested if they are useful. But other procedures than the ones suggested might be needed. So the practice inspector is kind of pleading with us to do something, not specifying a procedure to be done in every audit. So, specific audit issues. Now, an aside on documentation. There are things in standards where it says you shall document. So if someone comes along and says you haven't documented this and you say, well, I don't have to, they will be able to point to a specific paragraph in standards that says you have to do it. Now, I'm also going to say that most of those paragraphs where you have to do it are things that you would probably want to do anyway, even if they weren't required. Now, there are about 35 places where it says shall document, or for instance, it doesn't say you shall document the terms of engagement. It says you shall obtain the terms of engagement in writing. So I consider that effectively a shall document. So there are around 35 places that it says that. Now, all other requirements say the auditor shall, and there are lots of them, and there is no specific documentation requirement. Now, if you read the documentation section 230A7, it's pretty clear you don't have to document everything. It is neither necessary nor practicable for the auditor to document every matter. You don't have to document everything. The other thing 230A7 says is that some things document others. So having a planning memo documents that you did planning. So a planning memo will cover many of the auditor shall requirements, perhaps, because you've got a planning memo. Now 238, 9, 10, and 11 are things that say you shall document. And in paragraph 8 it says the experience, you shall document enough for an experienced auditor to understand. Now some people say that applies to everything. You've got to document everything in the audit sufficient for an experienced auditor to understand. That's not what that section says. It refers only to 3 or 4 specific items in paragraph 8. So all that said about analyzing what you have to document, the more you document, the better you are. If someone comes later, you're getting sued, the better the documentation in your file, the better the chance you will be successful and not get sued. So efficiency and effectiveness come into play. Don't have to document everything. Think about things that document other things, and be sure, absolutely sure, that the things that you shall document are documented. Now, for instance, and I'm going to discuss this more later, if you document what is required by 315.38, that documents almost everything that 315.13 to 37 say the auditor shall do. So if you focus on 315.38 and making sure, and that's an explicit you shall document. So if you make sure you've documented everything in 315.38 carefully and correctly, you're probably okay on all of 315. You might then just check and say, do I need a documentation prompt for some of the other things? Some of the risk assessment procedures, some of the understanding things, maybe I need a little prompt to remind myself that I should do that. Not particularly to document it, but to remind myself that I should do it. And oh, by the way, it documents it as well. Fine. So risk assessment procedures, 315. They are an essential part of planning. You have to do risk assessment procedures. Now the problem with 315.19 to 27 is it is written in the context of the largest multinational audit you can imagine, with the most sophisticated set of internal controls you can imagine, and with a highly sophisticated control environment. If you try to apply those paragraphs literally to a smaller audit, it's undoable. You can't do it that way. But 315 includes a whole bunch of scalability provisions. It says, okay, in a small audit, ignore what the section says, do it this way. If you do that, you can find a very efficient and effective way of doing a small audit and documenting it. Now, Practice Inspector talks about information processing and flow of information. Yeah, and you have to do that. But the scalability provisions in 315 can make this very simple for a small audit. So the forms you use have to be sure to use those scalability provisions so you can do it and document it. And you just have to do it. And it's essential. Planning is essential. You have to do it. Management knowledge of fraud. And of course, actually, it's fraudulent financial reporting. 18 through 22. Now, it's not a required documentation section, but It's kind of important to do so, so you don't have to do it, but I would heartily recommend that you do so. And it ain't hard. We're going to see that this isn't difficult. So paragraph 18, there are 4 things we have to ask management. Standard representation letter paragraph. And if you read the application material, they give you hints as to what management might tell you to satisfy 18. So put those in a standard representation letter paragraph and do it all the time. You have to ask about known, suspected, or alleged fraud, fraudulent financial reporting. Standard representation letter paragraph. We are not aware of any known, suspected, or alleged fraud, or we have advised you if there is any. Something like that. Got to do it. If they have internal audit, you have to ask internal audit about fraud. Most small clients will not have internal audit. That's not applicable, but you might have a checklist prompt to say, if there's internal audit, have we asked them? And most of the time that'll be not applicable, but maybe not a bad idea to have a checklist prompt. Have to understand what those charged with governance do with respect to fraud. Have a checklist prompt. And they missed 22, which is you have to ask effectively the same questions in 19 about what you ask management. You have to ask them, those charged with governance, about it as well. Get those charged with governance to sign the representation letter that we've developed in accordance with paragraph 19. So not required to document, but certainly wise to do so, and best to do in writing, not verbal. Though a verbal works, but the other thing about doing it verbally takes far more time than having it in the rep letter. So have it in the rep letter and get it documented in writing. A planning meeting. And here again, I sense practice inspector frustration, because this has been required. Now, 315 was revised 3 or 4 years ago, but basically 315 has been in the handbook for a decade, and probably since 86. The requirements in 315 have been in the handbook, in standards, for a long time. They have been written in greater and greater detail over time. But what's required in 315 has been there for a long time. And the requirement to do planning has been there for a long time. Now, technically, 315.17 requires a discussion, not a meeting. So I kind of disagree with the planning practice inspector and say you have to have a planning meeting. No, you don't. But a meeting will do. If the engagement partner is attending the meeting, and I see people going, oh, we'll have a planning meeting with the manager and all the staff. That's not a planning meeting. That's not planning discussion, because the engagement partner has to be there. And again, planning is essential. Now, if you document what's required by 315.38, and we're going to go through that in a second, I think you've documented everything required by 315.17. And I'm not in favor of a meeting because it's extra documentation and it's possibly inconsistent, that you will document what you said at the meeting and do that inconsistently with what you're doing in assessment of risk and material misstatement. So you can have a meeting, I guess, but I wouldn't particularly document the meeting. I would document what is required by 315.38. And again, planning is essential. So if you're not doing planning and the practice inspector is nagging you, saying, how do I get this? How do I get through to you? Have a planning meeting. That means you're not doing it right. Now, 315.38. And let me start at the bottom. Let me start with paragraph D. You have to document the identified risk of material misstatement of fraud and error at the financial statement level. And 330 requires a response, which is actually a pretty simple response. We'll talk about that in 330. Got to do it. No question. This is a shall document section. You have to document the identified risk of material misstatement of fraud and error at the assertion level. So you have to document by assertion, by component, disclosure assertions as well, and high, moderate, or low, or significant, and why. So you need a document that does that. Cash, existence, ownership, whatever the cash assertions are, high, moderate, low, you've got to do that. Cash, accounts receivable, all the way through all the income statement, balance sheet disclosures. Required. Got to do it. You got to document significant risks. Now, high, moderate, low, a significant risk is something that's probably much more than high. It's something where you're pretty sure it's wrong, and we're going to have to do some very specific and detailed work to find out what's right. Have to document that, obviously. Risks where you have to test controls, and there are some places where substantive testing is going to be ineffective. Completeness of transactions sometimes you can't do substantively. So you got to think about that and decide where we have to test controls. We have to test substantively on everything, but sometimes we may have to test controls. Document that. And then the rationale. Why is it significant? Why is it high? Why is it moderate? Now, if it's low, risk of material misstatement is low, that's because I can't think of anything that makes it other than low or negligible. So you really don't need to document low, because low is I can't think of anything. So that's quite a list of things we're supposed to document. Now, if we go back up to A, we are supposed to document the discussion about the suitability of the framework and risk of material misstatement. Well, I think we document that almost completely in everything in D. Significant decisions, well, significant risks and rationale, that's done in D. Our understanding of the client, need a checklist and apply the scalability provisions, so we have to do that. The risk assessment procedure is done, we have to do that. We need a checklist to direct that. Design and implementation of controls, not necessarily testing, and not necessarily in the details suggested in 350 in the sections. Read the scalability provisions and we'll find we don't have to do all of that. So we need a checklist and we need documentation, but we can use the scalability provisions to mean we don't have to do that much. So planning is essential. Now, the other thing is if you do 315.38, we've basically documented everything in 315, 17, and 18. Paragraph 18 requires us to tell people not involved in the discussion what they have to do. If we've documented 315.38 and we have an audit program and we've got a list of why we think risk of material misstatement is moderate or high, we've communicated everything we need to do. Now, there's technically no requirement to document 17 and 18, but 315.38 documents it all. So, like I said before, 315.38 basically requires documentation of everything in 315. And plans are worthless, but planning is essential, Eisenhower, so kind of agree with that. Planning is essential in an audit. Now, if you want an inefficient audit, too much time taken, don't plan. If you want an ineffective audit, don't plan. If you don't mind that work in process is 2 or 3 times how much you think it should be, don't plan. What you will find happening is staff members finding in a course a really cool audit procedure will decide to add it to every audit file, whether it's justified by risk and material misstatement or not. So if you want that, don't plan. If you want to miss a risk of material misstatement, if you'd like the financial statements to be wrong, don't plan. If you want unhappy staff, we're doing way too much work, and staff will know when they're doing too much work. They may not know exactly why, they may not know how to fix it, but they'll be going, I hate auditing, this is stupid, we're doing too much work. So if you'd like that, don't plan. If you want lots of review notes, don't plan. And if you want the planning reviewed in at the end with way too much time taken, don't plan. So planning is essential. Analytical procedures in planning. They refer to 230.23. I think 315.14b is better, but analytical procedures as part of planning are highly effective. And there was a study done by Hylas and Ashton back in the 80s that demonstrated this. And actually that study is why it's in standards, because they found that they're very effective procedures as part of planning. So it's required that you do them as part of planning. And they're highly effective and cheap as a test too. They can be a substantive analytical test. Many of these standards, if this standard wasn't there, I would still want to do it because it's so effective. Now, risk assessment procedures shall include analytical procedures, and you need to do analytical procedures at the end. That's in 526. So there are a number of paragraphs that require you do analytical procedures as part of planning, suggest you do them as substantive tests, and require you to do them at the end as the partner is reviewing the file. So analytical procedures are highly effective, and if you're not using them, particularly during planning, you're missing out. So the practice inspector is begging you to do this. Design and implementation of substantive procedures. Again, I think the reference is wrong. I'll show you a better reference in later, 330.18 and 506. I think there's sometimes 2 or 3 paragraphs require you need to read them together and to decide what you do. You need an audit program. Having assessed risk and material misstatement, part of planning is develop an audit program. It says, okay, here's either say, okay, here's the outline of how I want you to do it along with normal audit procedures. These are the specific ones we want. The audit program, I think, really has to be tied to your assessment of risk and material misstatement by assertion. So you need to think in the audit program, what assertion is this test addressing? And have the procedures we specified addressed all assertions, or we missed one. So we kind of need to do that. And as I say, the program also satisfies 315.18, would tell those not involved in planning what they should be doing. So if you write an audit program, so this is what you should be doing, you satisfied 315.18. I like 330.28. This is a shall document. And if you read all 3 of those paragraphs together, shall document the overall response to risks at the financial statement level. And there's a list in 330.A1. Put it in a checklist and do all of them. They're pretty simple. Document the nature, timing, and extended procedures and audit program. This is one I think people miss. The linkage of the work done to the risks identified. I don't think that's done sometimes at all. You need to have a very specific audit program that links the assertions to what you're doing, and then you can demonstrate the linkage. And then the results of the procedures, they'd be in the file. Now 330.18, what it says is do substantive procedures on all transactions, balances, and disclosures. And analytical procedures are substantive procedures, so we have to do that. And 506 says design and perform procedures, which basically is the same thing that 330.28 says. And both are shall do but not shall document, but by the time we get to 330.28, we got to document 330.18 and we got to document 506. So once again, one thing documents another. Don't do those. There's 3 paragraphs there. Don't have 3 separate sets of documentation. Have a single set of documentation complying with 28 that does the other 2. Now 240.33a, journal entry testing. I don't care, you got to do this. And please don't observe that it's kind of stupid testing, because I might just be forced to agree with you. However, one of the things you got to remember is the odds of us finding fraud are pretty slim. So if you get into a situation where you have missed a fraud, which is eminently reasonable, and there are required fraud detection procedures that you haven't done, the lawyer for the person suing you is going to have a lot of fun with that. And they're going to say, well, you didn't do this. Now, you may say, well, but if I had done it, it wouldn't have caught it. They're going to go, Your Honor, they weren't paying attention. If they had been paying attention, they would have caught it, and proof of them not paying attention is not doing the procedures required by 240.33a. So if 240.33a required us to do more than, I don't know, 5 minutes of work, I might agree with you, but this isn't going to take long, so do it. The three things we have to do are: first, ask management about inappropriate or unusual activity around journal entries. Simple. Have a representation letter paragraph in every audit. We are not aware of any inappropriate or unusual activity around journal entries. Done. No time at all. We have to select year-end journal entries. Now, technically, we don't have to do anything after we select them. So we could say, okay, I selected 5, there we go. And I didn't do anything because I wasn't required to. Well, probably not. By the time we get to 330.20b, it repeats this little double I and says examine. So we need to have a checklist step to remind ourselves to do this. Now, in a small audit, maybe the only year-end entry the client has made is they've recorded depreciation. Big deal. We have probably already tested the depreciation expense for the year when we're doing fixed assets. So we've already tested it. So we would observe to ourselves, well, there was only one year-end entry and it was recording depreciation, and we tested that in the fixed assets section. The other thing that may occur in a smaller audit, probably does, is most, if not all, of the year-end adjustments journal entries were done by the auditor, proposed by the auditor. The client's agreed. So we've already tested them. So other than a checklist step that reminds us, have we selected and examined some, not all, year-end journal entries? When we get to that step, we're probably going to say, well, we've already done that. Now, the reason for this procedure is that there was a famous fraud probably 20 years ago, maybe even more, where the client had $60 million in accounts receivable, and at year-end made a journal entry, debit accounts receivable $200 million, credit revenue $200 million, no support. And somehow or other the auditor didn't notice this and didn't test it, and surprise, surprise, it was fraudulent. It was fraudulent financial reporting. So standard setters said, okay, you should select and test year-end journal entries. Now, I don't know, but if I were faced with a lead sheet that had accounts receivable per trial balance $65 million, and we'd done whatever testing we needed to have done on those receivables, and then I observed that there was a nice round number, $200 million debit accounts receivable credit revenue with no support, I think I might have asked what that was. So I don't know that I need this paragraph to tell me to do that, because I think I already would have done it. But never mind. In this circumstance, the auditor didn't. So we're reminded to pay a little bit of extra attention to year-end journal entries, particularly if they're funny looking and made by the client. In a small audit, probably never happens. Number 3, consider. Doesn't say you have to. A lot of people interpret this that you have to. Just says consider. So you need a checklist step that says, I considered testing journal entries throughout the period, and A, decided it was unnecessary, or B, for the following reason, decided it was necessary. Now, the other thing I see people doing is say, okay, let's select 60 journal entries from throughout the period, and we'll select them randomly, and we will look at the journal entry and see if management's approved it. That won't work, because we're assuming in this testing that the journal entries are fraudulent financial reporting perpetrated by management. So looking at management approval doesn't help at all. So we need to think harder about how we're going to test this, and seeing we need to have a reason for why we're testing it. Presumably the reason for why we're doing it will tell us how we go about doing it. I quite candidly can't imagine the need for testing throughout the period, but if there is, you need to do it. But all you have to do is consider. Now, this has been in standards since 2010, 14 years. Come on. I don't care, it's stupid. It doesn't take that long. Couple or three checklist steps, do it. Accounting estimates 540. Apparently there are significant accounting estimates and we're not testing them. This should be in the audit program. Accounting estimates are depreciation. We should be routinely testing that. Allowance for doubtful accounts, we should be routinely testing that. If there are other more complex accounting estimates, we need to refer to 540 and do something about it. It should be in the audit program. Often in a small audit, it's not hard. Pay attention if there are accounting estimates. Put it in the audit program. Date of the rep letter. Now, in fairness to practitioners, this is a little complex. 580.14. A bit complex. It requires the rep letter to be dated shortly before, but not after. Not after should be obvious, but what's shortly before? 2 days before? A week before? A month before? 2 months before? I don't know what that means. Now, the other thing we have to remember is the only subsequent event testing we do, or at least the most significant subsequent event testing we do, is asking management if there are any, and that's in the rep letter. So, and we have to do it up to date of the audit report. So, we date both of these reports. We date the letter and the report. Make them the same. Then we don't have a problem. We don't have to think about shortly before. We date the letter, we date the report. Now, the process is going to be, because we have to know when the board approves the financial statement, because the audit report date can't be before that. It has to be the same or after, so it's got to be the same. So we have to talk to the client about the day the board is meeting to approve the financial statements. So once we know that, we can date the report and provide a draft report and draft financial statements. And we can provide a draft representation letter dated a couple of weeks in the future and say, when the board meets, please confirm that they met on that date, sign the rep letter, and get it back to us. And you can't have the financial statements until you've done that. So we need to understand that's a bit of a process, but once you get the client used to it, and once you get used to it, rep letter, audit report, same date, the day the board approves the financial statements, and you don't get your financial statements until we get the rep letter back. Misstatements indicative of fraud. It's required. Now, it's an auditor shall, not an auditor shall document, but I kind of want a checklist step saying I considered whether misstatements were indicative of fraud and concluded that they weren't, which would be the normal circumstance. So have a checklist step that responds to those two paragraphs and do it. You've got to assemble the file on a timely basis, and the application material says you've got 60 days. Do it. This has been around for 14 years. So develop a process whereby, now if you have a paper file, the paper file is sitting in your office, it's been reviewed. Review has to be done before you can issue the financial statements. So the file is complete. The review notes have been thrown out. Don't keep review notes in the file. So all we're waiting for is the financial statements and a rep letter. So we've issued draft financial statements, draft rep letter, we know the date. We're waiting for the rep letter to return. When the rep letter returns, we issue the financial statements. The rep letter and a copy of the financial statements go on the file, which is like a day or two after they're approved. And so we document the date that we did that, and it's within 60 days, and we're good. I used to have a stamp on a paper file. I had a stamp, file completed such and such a date, and said it had to be within 60 days. Hard to put that in a checklist because the checklist is completed before the financial statements are issued. So you need some other process, and with an electronic file, you're going to need an electronic date when things were completed. Document the date you assembled the file and do it within 60 days. 14 years. Review issues. Have to understand the client. Of course you must. what the practice inspector observed, that there was very brief understanding documented, and they thought perhaps in the circumstances more was needed. So you need to think about that. Now, brief can be okay for many. You're doing a review engagement on a restaurant. What's the nature of the business? It's a restaurant. What kind of accounting do they use? They use QuickBooks and they reconcile the bank once a month. That may be all you need to, because all you need is an understanding sufficient to do the review engagement. So you have to decide. Now, if you have a client that's using percentage complete, if you have a client that's in the farming business, you may need to know and document a bit more. There are new standards for accounting for farming. Need to know about that. So you got to do it, but it doesn't have to be complex. It doesn't have to be long. But you need to, as a practitioner, conclude whether there's enough there. I've heard people say, well, I'm doing a review for the partner, and I have absolutely no idea what they do. I don't know what their business is. I don't know what accounting software they use. Well, that should be impossible because it should be documented in the file. And that should be impossible because the partner should have planned both an audit and a review, and at very least explained that to the person doing the file so they know what to do. Planning is essential. Likely material misstatement. Now, the section's a bit confusing, perhaps a bit unclear. And we have to determine if material misstatement is likely. And likely is probable. So that's really high, that material misstatement is probable. That's certainly higher than high risk of material misstatement in an audit. It might be somewhere around significant, maybe a little less than significant in an audit. Not really good definitions of these terms. But it's pretty high. So how do we do this? And the section is unclear. Now the section requires we do something on all material components. I'm going, it's going to take me some time to consider whether something that is less than my materiality is a material component. Cash might be less than materiality, but it will be a material component. It could contain a material misstatement. So my view is it's simpler to just do inquiry and analytical procedures. They're not hard on everything on the balance sheet, on everything on the income statement. And then I don't have to spend any time figuring out whether it's material or not material, and I can ignore it because what we have to do is so simple. So do that. Do the inquiry and analytical procedures on all components to determine whether or not material misstatement is likely, and then conclude. Now, if you conclude that material misstatement is likely, got to do some more stuff. What you got to do, I don't know. It will be proportionate to what you've concluded. In a typical review engagement, my experience, it's never likely. It's never even above low. These are very simple clients. So that often does not happen. If you do the inquiry and analytical procedures and you conclude material misstatement is not likely, I would then conclude that I've done enough on everything. I'm finished. So you need a checklist that supports that. You need a checklist that lists the inquiry and analytical procedures you want to do on everything. Then you need a spot to conclude, has that given me the inclination that material misstatement is likely? If it hasn't, I'm done. And there are other representations I have to obtain, and there are other things I have to document, and the checklist should direct that as well. Then I'm done. So that's the way you address that. Very important to do a review engagement correctly. Now, other things that apparently weren't done in review engagements. Didn't consider the reporting framework. Now, if the reporting framework is GAAP, GAAP for small businesses, GAAP for not-for-profits, pretty simple. We understand that. If you're going to use the gap for farming, not that familiar with that. Maybe I need to know some more about that. Now, if it's simple, fine. If it's not, you need to do more. They're nagging us about comparing or documenting analytical procedures well. Now, we have to remember that no expectation is required. I think we need a checklist that says, I compared this to that, and that documents it. And you only do inquiry and analytical procedures unless you identify a material misstatement being likely. The other thing about a review engagement, there's no mention of fraud. We do not mention fraud ever when we're doing our work. It is only in the rep letter, and that's when we say we have no responsibility for fraud. Management does, and that's repeated in the report. Required inquiries. They criticized for one-word responses in a checklist. That's one of the reasons I want these inquiries documented in the rep letter. And I think you're wasting time if you have a checklist of all the inquiries we're supposed to make, and you sit down with or phone or Zoom with the client and say, are you aware of any fraud? No. Well, that's not a review question. Are you aware of this? No. Are you aware of that? No. Are you aware of this? No. I don't like that because it's not in writing. I like management responses in writing. So later when we say, well, you told us, Bill told us that this didn't happen. And we go to Bill and Bill says, I never said that. And we're stuck. He said, she said. So I like all the things that we're required to inquire about in a review engagement in writing in the rep letter. And there might be a checklist prompt to make sure you get it in the rep, but I like them all in the rep letter. Quality management issues. Now, some of these have been required since 2009, 15 years. Some of them only since 2021 when things were revised. And some actually don't come finally into effect until December the 15th, 2024. So there's still some time. But come on. You need to update the documentation. That's a 2021 issue. You need to revise your firm quality management policy. Do it. You need to do an annual evaluation of your quality management process. You need a checklist to do it and a prompt to remind yourself to do it. Once a year, you got to fill out a checklist. So have a checklist and do it. If you are a compilation only firm, this is the one that you've got till 2024. I kind of don't understand this, and I guess I don't understand it in two ways. I've always felt if you did audits and reviews and compilations, that you wanted to do a quality management review of audits. That's more work. Reviews, a little bit less, and compilations, not very much at all, but I want to be sure that we are doing our audits, our reviews, and our compilations properly. Now, doing a compilation properly, all you got to do is check that we did no work. We issued the correct report, which apparently some people didn't do. And we used the new checklist because there's a whole mess of things in compilations that we have to document. So want to make sure we've documented all of that, want to make sure we've done no work. Doesn't take that long to do. I would have argued that I always wanted to do it. So it's easy to get some forms and do it. And if you haven't done it yet and you're a compilation only firm, you've got until December the 15th. Get it done. And you need to integrate into forms the rules about acceptance and independence, etc. I'll leave that to you. The accounting note in a compilation. First of all, I don't understand why we need to do that. It seems to me rather silly. We've done no work, so we have absolutely no idea whether the note is correct. None. And we've done no work to make sure it's correct. and third parties are allowed to use this, and they're going to be assuming that it is correct. So I don't get that. But what apparently some people have said is, oh, okay, our base of accounting is accounting standards for private enterprises. Well, you have no idea whether or not the financial statements are in accordance with accounting standards for private enterprises. There is no statement of changes. There are no notes, which would be required by accounting standards for private enterprises. So you have no idea. Now, the practice inspector is polite and says this may cause confusion. I would say this causes legal liability to a user who assumes assurance and assumes you've done it, assumes you've done financial statements in accordance with accounting standards for private enterprises. There's even a suggestion that you can do a compilation in accordance with IFRS. I don't understand that. We have no idea. Now, a note might look something like this. If you look in the compilation section 838, they have some wording suggestions. I modify it a bit. I say basis of accounting selected by management because I want to make it very clear that we, the accountant, had nothing to do with this. And then the financial information has been prepared in accordance with a cash basis of accounting with selected accruals and accounting estimates. That actually, we can be, without doing much, we can be sure that that's what has been done. So it's not a lie. And it won't mislead anybody. But we've done no work. We really can't be sure. So again, we want to be clear that we did not pick it. It's not us saying. And you got to read the section very carefully because every once in a while there's kind of an implication that the external accountant is doing things or undertaking procedures, and they're not, and it's not as clear as I would like it to be. Now, when you look at it hard, you go, okay, it's not really saying that, but you could misinterpret it that way. So the note has to be something that we can know is mostly true, having done no work. And seeing that's what the section suggests, good for me. Now, as an aside on wording, and maybe I have occasionally I've done this wrong, so just to make double sure, and particularly when we're writing things in a file, don't use audit words in a review, and don't use audit or review words in a compilation, or you're at risk that someone after the fact will try to argue because you've used audit words in a review or audit words in a compilation that you weren't doing a review, you were doing an audit, or you weren't doing a compilation, you were doing an audit. So be very careful to use the right words in the right assignment. And for instance, audit words are risk of material misstatement. Only use those words in an audit. Risk assessment procedures. Only use those words in an audit. Sufficient appropriate audit evidence. That's largely an audit word. We will see it's occasionally mentioned in a review. So just to be clear, I would be careful not to use it in a review. I mean, it's occasionally mentioned in review standards, but we're not attempting to obtain sufficient appropriate evidence in a review. Fairly presented, audit words. Now, I don't mind conclusions by section in an audit, but don't do more than that. I think a lot of time we waste time writing a conclusion on each audit procedure, for instance. Single conclusion by section and a single conclusion and another conclusion on the audit as a whole. Review words, material misstatement likely, not risk of material misstatement. We are attempting to determine whether material misstatement is likely. And as I said before, care with sufficient appropriate, I would prefer just not to use it. Our conclusion in a review is, and it's long-winded, nothing has come to our attention that causes us to believe the financial statements do not fairly present. That's from 2476, and those words are in the review engagement report. Now, in a review, I prefer a single conclusion so we can be careful with the words we use. So I don't think we particularly need to spend time having conclusions by section. We have a single conclusion at the end that uses those words from 2476. Compilation words. Now, we're never going to mention the word risk in a compilation. We're never going to mention the word fraud in a compilation. Now, I believe it's in the engagement letter where we make it clear that management is responsible for fraud, not us, but we're not going to mention the word fraud in a compilation, unless, of course, we find it, but we probably won't. The conclusion words are does not appear misleading, 4224. Now, we're doing no work, so again, I prefer a single conclusion. I don't want to have does not appear misleading sprinkled 10 or 20 times through the file. It's just a waste of time. We're not doing any work. We have a single conclusion that it does not appear misleading. So let's just be careful with our wording in audits, reviews, and compilations. Now, the issues in this report, and why I say come on, these have been repeated for many, many years. And the practice inspector is not pointing out that you could be sued because of this, probably to try to protect you. But these all place the practitioner at risk because they all put you in a situation where the accounting is wrong, where you've not documented enough or not done enough audit or review work. So really, just imagine how frustrated the practice inspector is having said this year after year after year, and people aren't listening. So it's time to listen and time to do it. So thanks for listening.